Hi, everyone. You're watching episode 60 of Yield TV. Oh, there we go. Sorry, Teddy. It looked like my video sort of crapped out there a sec. Hey, everyone. So it is Monday, January 18th, 2021. Thanks for tuning in. This is going to be week 3 of DeFi Class. So this is a weekly segment that we're doing every Monday on different fundamental and advanced DeFi topics. Today, we're going to cover all things related to DeFi lending. It's one of the most popular and common use cases in DeFi. And we're fortunate we've got Teddy Woodward, who's the co-founder of Notional Finance, which is a borrowing and lending protocol for fixed interest rate lending. So anyways, Teddy, welcome. How are you doing?
I'm doing great. Thanks for having me, Travis. I'm really excited to be here. Yield TV is a giant in the space. So appreciate the invite.
Yeah. No, this will be great. Really appreciate you and others that have joined us, just being gracious enough to help us teach some of these topics. So one thing before we actually get started on this is I wanted to call out that we do have a new farm tab on Zapper. So let me just pull this up on my own Zapper dashboard. Here we go. So if you use Zapper, you've probably noticed that the interface has changed just a bit. So the dashboard is still in the same place here, but if you look here up top, you can now see that we've just moved the exchange over one tab just so it's more convenient. We now have a tab for liquidity pools, which used to be the invest tab. And then separately, we have this tab for farming. So this is like an aggregator of all the different farming opportunities in DeFi. We've got about, at this point, 12 pages, so about 120 plus opportunities. This is a page that we are looking to aggregate more and more. So there's a lot here to add. And if you find something that you think is a great opportunity in DeFi that involves some sort of yield farming aspect, normally like providing liquidity or lending and then staking that liquidity, let us know. We'd love to hear from you in our Zapper Discord. So what I normally do with this, and this is not financial advice, but this is just how I go about using the tab. I'll go here and I'll search for something like, let's say a token that I want exposure to, or maybe a protocol. So we have all these different sushi swap and sushi related opportunities. So I see here that if I am a sushi ETH LP in sushi swap, there's an opportunity here, which is estimated to be around 27.8% annually or 0.53% returns weekly. So then what I could do, if that's the sushi ETH, make sure I'm showing this number 2 here, sushi ETH, I can hop over to the pool tab and then I can look up sushi ETH. There we go. You can see the little farmer icon. So we hopped from farm, which is the aggregator of opportunities, to pool, where we're becoming a liquidity provider in a pool. And then I could go here and add liquidity. Once I do add that liquidity, you will see things like, you'll see it actually up above here in the pool tab as well as the farm tab. You'll see opportunities to stake. So there'll be a green button here. Instead of claim rewards, it'll say stake. And yeah, that'll allow you then to participate in those different opportunities. Just make sure, of course, you make your own decisions. None of this is financial advice, but this is meant to be a way to break down the barriers of all the information out there and enable the average person to be able to access that information on Zapper. All right, so there's our farm tab. Let's go ahead and get started then with DeFi Class. So DeFi Class, again, today it'll be on all things related to DeFi lending. And here's what we're going to cover. All right, so first we'll talk about how DeFi lending works. Then we'll talk about variable rates. We'll talk about fixed rate lending with Teddy here, and then how you can use yield bouncers as well as risk. So the yield bouncers refers to when you have lending opportunities with variable rates. there are different lending and borrowing platforms or protocols. And so you're going to have higher and lower rates. If you want to just move to what is the highest rate, you can use yield bouncers like Rari Capital. You can use Yearn.finance. You can use staked.us's robo-advisor for yield. So we'll talk through all of that. Teddy, would you be comfortable maybe talking a bit about, let's talk about your background for just a moment and Notional Finance. So how did you get into DeFi? And then I guess, what have you guys been building with Notional?
Yeah, sure. So I'll start quickly with just kind of who I am and what my background is. So I started my career as a trader. So I worked actually at an investment bank. I traded interest rate swaps. So I did that for about 3.5 years, and then I left banking to get into crypto and traded for another 2 years or so in London. And then basically towards the end of 2019, I really wanted to start a company, and DeFi was kind of taken off, and it seemed really exciting, and just like there was going to be a huge opportunity, which so far looks very much to be the case. And so at the time, kind of as you're going to talk about today, all of the sort of lending and borrowing opportunities were exclusively variable rate. And to me, that seemed like there was a huge opportunity to build a protocol that allowed people to borrow and lend at fixed rates of interest instead of variable rates of interest. Now, kind of based on my background, I knew that fixed rate lending was a huge market. And to me, it seemed like this was the natural next step in the evolution of DeFi and sort of the next thing that would really kind of move the space forward. And basically, I moved to San Francisco in the end of 2019, met my partner, who is he's a tech guy. He spent about 10 years in the Bay Area in tech. And in January of 2020, we started Notional. And just recently, so actually just last week, we did a full public launch of our product. So we've got the audits done, we have everything done, and it's ready, it's out there. And it's just been amazing since then. We've got about 5.5 million in assets on the protocol. And we've done about $1 million in borrows. Not quite 1 million, but almost 1 million.
Wow.
So we're pretty happy with what we've done so far.
Yeah. No, it's always exciting when you discover, yet another fundamental building block that's already been launched and has some traction, is being used. Those numbers can quickly grow to 100 million and beyond. So yeah, congrats on the launch back in October. And so let's do this then. We're going to actually show how Notional works as just part of the lesson today. Mm-hmm. So I think first off, let's talk about how DeFi lending actually works. And what I'm going to do is, let me share my screen a sec. I want to show DeFiScore.io. So this is a place where you can actually compare lending rates, which refers to variable interest rates. So, okay, in a nutshell, the way that lending and borrowing works in traditional finance is that think of it, and I'm trying to dumb this down as much as I can in case folks are don't have a background in traditional finance. The bank has all this money. When you put your money into let's say a savings account and you earn 0.01%, whatever pitiful rate it is with Bank of America, you're essentially lending your money to others who are using different banking products. And so if you think of the fact that the bank itself has lights to keep on, they've got buildings to have people work out of, they have all this overhead. And so as borrowers are paying an interest rate to borrow, that money is being used by these profitable entities called banks to be able to, offer these services. So with DeFi, we flip that all on its head and we automate it with software. So what you're looking at here on DeFiScore.io is a comparison of, we've got different platforms. We've got Aave, DYDX, DDEX, Compound, Oasis. These are different platforms where one could, borrow or lend different crypto assets. So we've got synthetic USD, Tether, USDC, DAI, and so on. So at the end of the day, what happens when you remove all of the overhead, all the people who basically drain the profits in the bank? Those are the people that work for the bank, and they, all of those costs mean that us as lenders to the bank don't earn as much. So the crazy thing is that here we're automating it with software, and that's why it's part of the reason why there's lots of other variables, but it's part of the reason why you see that suddenly you can earn 7% on USDC on a bad day. You can earn 13% here with Tether on Aave. You can earn 75%, which is a rate that could go down a lot by tomorrow, but as of today, it's 75% APY. So Teddy, I'm going to pause there because you're the one with the traditional finance background. Anything to add there in terms of how you think about DeFi lending and how it works?
Yeah, no, I think that's pretty right on. I mean, I think the main thing to get here really is that, what you're doing is you're just taking the bank out of the equation. Kind of, as you said, there's and I think you're even a little charitable, Travis, because it's not just that they're covering overheads. They also like to make a lot of money. So so basically what DeFi is doing is just taking the bank out of the equation. The lenders and the borrowers are interacting directly, and the interest that the borrower pays goes directly to the lenders, and nobody really comes in between. And that's the big thing, right? I mean, that's what we're all doing here in DeFi, and yeah, the potential is significant.
Yeah. So one of the most interesting things about DeFi lending is I think that you will find that when you're speaking with those that are trying to wrap their heads around DeFi, especially crypto natives, it's just the simplest use case to understand that you have an asset that's sitting in your wallet, and if it's not earning you anything, other than obviously we are long on different crypto assets because we think the price against, let's say, the US dollar, other fiat can go up over time. But when you find out that you can also earn additional amounts of that just by lending it, it's an awesome thing that you discover. So what I want to, another thing I want to cover here. So let's move on to lending with variable rates. Because this is really what's been one of the most popular use cases in DeFi, and then we'll talk about fixed rates right after. So let me share my screen. All right, so I'm going to show off Aave here. Just want to make sure I have the right tab here. All right, forgive me if I end up having, oh, there we go. I'm on the right tab. Okay, so here is an example of a money market. I've got, now this is Aave V1, which they've moved to V2, but just for the sake of showing this off, you can see all the different assets here. And then up above, we have deposit APY, or what I earn from lending, versus what I can pay as a borrower. And then Aave has these stable borrow rates as well. So an example here is if we look at my dashboard, I have some Wi-Fi that's been deposited. It's earning 2.62% as of today. However, all of this is dependent upon the demand for borrowers who need Wi-Fi. And so you can see up above, 39.3% of the pool has been used with 2,237 Wi-Fi still available in liquidity. And so the more that gets borrowed, in most cases, again, throwing aside some other factors, the simplest way to think about it is the more of the pool that gets utilized, the higher the rate goes. It incentivizes more people to deposit liquidity and to earn. At the same time, if the utilization rate goes down, then there isn't demand, and hence the rate here, this deposit APY would go down because we don't need that much more liquidity to meet demands. So again, going back to my dashboard, simple example is like I could deposit more Wi-Fi here. If I had more Wi-Fi, let's see if I've got anything else here that I could deposit or just at least give you an idea. DAI. Yeah, here we go. I have some DAI. So, I could put in, let's say 100 DAI. And then this would be me lending that 100 DAI. On the flip side of that, I also, as a borrower, I put up this collateral and then I borrow a fraction of it, which depending on which collateral you're talking about, like let's say here with Wi-Fi, the loan to value ratio is 40%, I think is, yep, 40% here. So it means that the maximum amount of money I can borrow against, let's say I have $1,000 of Wi-Fi, the maximum I could borrow then would be $400 in this case. So this is how variable rate lending and borrowing has worked. It's very popular. It's at this point, like if you look at the total value locked across Aave, Compound, gosh, who else am I thinking of? BZX, DYDX. This is a use case that has a lot of demand and a lot of participants, and it only grows more and more every day. By the way, one thing I'm leaving out there is make sure you check out, this is, whoops, let me flip that to DeFi Class. Make sure you check out Aave V2. Oh, shoot, hold on. Screen, too many different. Oh my gosh. Oh, this is killing me. Let me X that one out. Oh boy, here we go. So here's Aave V2, and this is where everyone will migrate to, and so you will see a difference in rates. If you go into V1 versus V2, they're completely different pools of capital. So there's different demand, different supply being the lending, and so you'll see different deposit rates. And once you migrate over, probably the most interesting thing here is that you can do credit swaps. So that means that if I have, let's say, USDC, let's pretend I'm lending USDC or DAI, and I'm earning 4.89%. I notice that I could be earning 5.81% with USDC. I can swap my collateral so it's a credit swap from DAI to USDC. And all of this is going to be familiar to Teddy. Like these are building blocks of traditional finance that if you talk to a friend who's worked in traditional finance, they'll recognize that as a credit swap, and that should get folks excited. Okay, Teddy, anything else you think we should cover on variable rate lending and borrowing?
Yeah, I actually, yeah, I think so. So, when I first came into the space, one of the hardest things for me to understand was, why is anyone borrowing? I think that's like one of the biggest questions that a lot of people have. Like, so it makes sense, all right, if I own some Ether or I own some USDC, of course, I want to earn some extra yield on whatever tokens I own. But what about the other side? Like, who's borrowing and why? Right? Because like that was a question that, it took me a long time to understand, because it can be difficult to find people that are actually doing it and ask them. Because crypto is prioritizes anonymity. So I think maybe we can just say a couple words on why people are doing that. And I guess probably the most common use case and the most common reason that people are borrowing, it's simply because they own Ether or they own wrapped Bitcoin or they own whatever crypto token, and they want to access working capital. So they want to access stable coins like DAI or USDC, but they don't want to sell their Ether or Bitcoin. Like that's ultimately what they want to do. So they want to borrow USDC or DAI and use that USDC or DAI for something without having to sell their crypto that they're long, because they want to stay long. And so that's like, ultimately that is the number one reason why people are borrowing, at least so far as I know. And so it really helped me when I sort of got to understand what people were borrowing for. So I'll just say that here.
No. That's really helpful. I think, I mean, I can attest to that. Like, that's one of the main reasons I enjoyed DeFi lending and borrowing protocols, is because I can borrow against my collateral, and I can open up a essentially then a leverage position. Another thing, though, to point out here is, so we're not going to talk as much about borrowing, but like we have to touch upon it because it's like part of the mechanism that it's part of the reason you can earn interest. It is the reason you can earn interest. But you don't have to, again, participate in any sort of borrowing. That's why lending with, let's say Aave, lending with Notional, which we're going to cover in a second, lending with Compound, it's a way to put your assets to work. Oh my gosh, I'm embarrassed. I forgot Cream, of course, as well. Cream's another really popular one that is a part of the Yearn ecosystem, and they really have been bold, I think, in listing interest earning or yield returning assets. So make sure you check out Cream as well. Okay, so one last thing on the variable interest rate lending. If we go to defiscore.io. So this is a tool that is made for you to compare different rates. And I'm going to talk a bit about yield bouncers a little bit later, which should negate the reason to need to use this. But if you consider the different platforms we were talking through here, the idea is that if you have variable rate interest lending, the goal here is to maximize that. And so you can look and say, hey, where can I earn the most? Well, here's by platform, but here's more importantly by asset. So you can go to USDC and see that currently DYDX is earning the most. Well, it would cost a lot of gas, which would probably eat up your profits, and it would cost a lot of time to be moving money around day to day. So that's why we use what's called a yield bouncer. We'll talk about it in a bit, but it basically is a way to automate moving your money from let's say DYDX to DDX to Compound to Aave and so on. All right, enough on variable rate interests. So let's talk next about lending with fixed rates. So Teddy, do you I could share my screen unless you would like to share yours, but basically I'd love to walk through Notional.
Yeah, sure. Let me share my screen real quick.
Awesome.
And I'll talk through the UI.
Cool.
All right, one sec.
Yeah, take your time here.
All right, can you see it?
Here we go. I'll add your screen. Once you hop over to the tab, I'll add it here. There we go. All right. Yeah. There you go, man. Yep, you are good to go. Yeah. So talk us through. So we already mentioned the value prop behind Notional is a borrowing and lending protocol with fixed rates. So from there, yeah, talk me through what are we looking at here?
All right, let me take it away here. So basically, this is the homepage, and what you can see here is a selection of your borrowing rate if you were to borrow USDC until July 1st, 2021. So that's about 6 months, and you could borrow that for 6.925% fixed interest. So I'm just going to take you through here, and I'll start with borrowing. I know it's a class on lending, so I'll just be very quick here. But for a borrower, the purpose of the value proposition here is kind of, as Travis was showing you, rates are extremely volatile. So the ability to sort of lock your interest rate is really valuable to people. And so what you can see here is that this is on the borrow screen, and we have 2 maturity options for you. So April 2nd. Or July 1st. And so this is what the rate you would get. As I put in the amount of DAI I want to borrow, the rate changes, as you can see. So 20,000. And I can change the amount of collateral that I'll have to post here in this nice little slider here. As you can see, as I get riskier and riskier, the amount of collateral that I have to post gets less and less. So that's borrowing. And then to go back to lending, let's check out USDC. So you can lend DAI or USDC at the moment.
Yeah, so that was Teddy, what you just covered, that's what enables all of this. And again, I know lots of folks, I think, get DeFi lending, but in case someone is new today, it's just like we talked about with the bank. Borrowers here are paying, in this case, a fixed rate to borrow. And then you as a lender, which we're going to cover here on the other side of it, you're earning a part of that that interest that's paid by the borrower.
Yeah, that's exactly right. So basically, here's the lending screen for USDC. Now, there's been a lot of borrowing interest here. So what this has done is it's pushed up the interest rate relative to DAI. So for example, on the July 1st maturity, you can lend at a fixed percentage rate of 6.58%, right? And so what that means is that, in contrary to kind of the variable rate lending protocols that Travis showed you, if you choose to lend here, you know exactly how much interest you are going to earn for the next 6 months. And that's, very valuable to people because, maybe if you're new to DeFi, you haven't really seen this yet, but interest rates are extremely volatile. And, if you want to be an active yield farmer, not only are the rates volatile, but it takes a lot of work, right? Because you have to sort of move your capital from one farm to another. You have to be pretty active. And the rates that you will earn will change a lot. And so with a product like this, you can, in one click, lend 100,000 USDC, for example, and at a fixed rate of interest, and you know exactly how much you're going to earn for the next 6 months.
And this is the advantage here then, Teddy, that we're pointing out is just that it's an expected return then. Like you said, it's fixed, so I know that I can earn that, which is more appealing to some versus the volatility of variable rates. With variable rates, again, I know firsthand, putting money into protocols like Aave, it can be fantastic. It's not saying that one is better than the other, but for those with, it might be someone who's a little more conservative, who wants to ensure that they're earning a certain amount, taking a certain amount of risk here. And so that's where these fixed rates become, I think fixed rates become really powerful as a bridge to those on Wall Street that are looking at DeFi. Gets them excited to know that, they can earn 5.9% through that date versus with variable rates. Sometimes we've all heard the criticism of yeah, that's great, the rates were really high, but those rates, can go up and down very quickly. And for all the risk we're taking, I'm not sure if that's what we want to do in terms of participating in DeFi.
Yeah, that's exactly right. So I might even look at this maybe you'd want a mixture of both variable and fixed, right? Kind of in the same way that, if you have an E-Trade account, maybe you have some amount of your assets in something risky like equities and some amount of your assets in something a bit safer and more conservative like bonds, where you know exactly how much money you're going to make. So, I think that for some people, the same kind of logic applies. This is a product that gives them a way to sort of manage their overall risk in DeFi.
Absolutely. Teddy, anything else that you think is worth sharing here? Actually, we were going to cover this later, but maybe we should just talk about it now. What are the risks of using notional or any future fixed interest borrowing and lending protocols? What are some of the risks that we should think about as users?
Yeah. Okay. So I think that kind of with any DeFi protocol, and actually, let me unshare my screen now.
Yeah, here we go.
Yeah, but I think the risks of notional and the risks of fixed rates are kind of similar to any other DeFi protocol, and that's like the biggest risk, right? The biggest risk is that the protocol gets hacked, right? That is the biggest risk, at least for Notional, because other than that, you don't really have very much risk at all because your interest rate is fixed, so it's not going to change. But yeah, so the biggest risk is getting hacked, and I mean that's something we take, at least at Notional, we take extremely seriously. And we have gotten our protocol audited by the top firm in the space, and it's something that, yeah, we do everything that we possibly can to ensure that your funds are safe, because that is it's the number one thing that's important in DeFi. I think a lot of teams, teams take it in with various degrees of seriousness, and that's, I think, a reason why you've seen a lot of protocols get hacked, because people haven't been taking it that seriously, but we do. So
absolutely. I think I'm trying to think of any other risks just to call out. This is more generally speaking, like lending protocols, like most of DeFi. The top risk, which you called out already, is smart contract risk. Always consider that. No matter how many audits you see, no matter how reputable the team, no matter what big investors are behind them, everyone's vulnerable to this because code is still created by humans and it's audited by humans, so it's prone to human error. Another thing to be on the lookout for, not concerned here with Notional, but in general, as you see new lending protocols roll out, always question, never trust, always like verify per usual in crypto. There's no saying that there won't be, let's say, an anonymous team that comes out that releases something and maintains some sort of centralized, admin key where they can move funds. So just always be on the lookout for that. It's a reason to question jumping into something that is brand new before learning more and doing more research and watching maybe an interview on Yield TV or joining the Discord. You can learn from the actual team.
I would. So I would just say probably, some people are going to actually go through the GitHub and essentially audit the code themselves. And that's, more power to them. But, we're not all like that. So I think that a really good way of trying to sort of, build some kind of trust and like get to a point where you can feel comfortable is to join the project's Discord and just see like how people are behaving, like what kinds of things are they saying? What kinds of things are they talking about? Right. And just try and get a feel for who the team is and, the kind of environment that they want to promote. I would say that that's a really good way of trying to figure out, if you're comfortable dealing with a certain project or not.
Absolutely. One other risk that is always top of mind, if you are lending or borrowing a pegged asset, something like DAI, USDC, wrapped Bitcoin, reminder that despite how liquid these tokens have become, despite their rampant usage, there's no assurance that peg won't fail or that peg couldn't depeg and then cause quite a bit of trouble for all of us. And that goes back then to like systemic risk of using like a pegged asset. It's everywhere in DeFi, and I tend to at this point USDC, DAI, SUSD by synthetics. I personally am not worried about it, but that's my risk profile. I'm a little more, I'm risk on compared to the legacy world. And then I think somewhere in the middle in the DeFi space. So let's do one last point here for today, which is yield bouncers. So we talked now just about fixed rate lending and borrowing. Reminder, I guess there's no saying that yield bouncers won't show up for this in the future, but I think like mechanistically it doesn't make any sense because Part of the reason you used fixed rate lending is because you now have that expected assured return by, let's say, a certain date. For those that end up using variable rate lending, if you want to maximize the interest you're earning across, different protocols, what you can do is use a yield bouncer. So I'm going to quickly show idle.finance. Here we go. So there's multiple options here. Oops, there we go. Oh, there we go. Sorry, my MetaMask just clocked out. That's why. If you use, geez, actually, you know what? Hold on. Let me log back into MetaMask, because if I don't do this, then you won't be able to see what I'm talking about.
This is half the fun of DeFi right here.
Yeah, user friendly here.
Yeah.
By the way, worth going into your settings. Oh, I'm sorry, Teddy. Go ahead. What were you saying?
Oh, I was just going to say, kind of in passing, I've actually been quite surprised that that the yield aggregators, that what you're calling the yield bouncers here, that they haven't been more like that. The space hasn't consolidated. And like I would have thought that because you see, like kind of like what you were showing, there's different rates available all over the place, and I would have thought that they would have converged more quickly than they have. Yeah.
Yeah. You almost consider them like meta aggregators, like aggregators of aggregators here. Here we go. All right. Okay, so we're looking at idle.finance. There are different, so there's two different strategies. One is best yield. The other one is risk adjusted. The best yield, it's higher risk, higher reward here. So you can see, like, I currently have some money in a DAI strategy that is earning about 13.727% APY. You can see the other rates below here. SUSD is in higher demand right now. Maybe there's some yield farming opportunity out there and everyone's borrowing it and participating. That could be what's driving up the rate here. But idle moves money across, I believe, Compound, Aave, and I think DYDX. So why would I go to like DeFiScore.io that I showed earlier? Why would I put money into a single protocol if I know that something like idle will move my money to the highest rate across multiple protocols that I trust and am willing to have exposure to? So this is using automation in DeFi to maximize the interest that you earn lending. So there's that. There's one other, there's a few others to call here. Rari.capital, of course. Stake.us has a robo-advisor for yield. And then Yearn. This is actually how Yearn.finance got started, but I think people forget about it because everyone's so caught up in the more sophisticated Y vaults. So if I just quickly show you, this is actually available on Zapper. You can get into Y vaults, but this instead is this is purely lending, and this is bouncing your money from one protocol to the next. So we've got DAI, USDC, Tether, and so on. And you can see you can be earning 15.3% as of the rates and demand today. This could go down tomorrow. And Yearn is moving my money in this case across those different protocols. Different than that are Y vaults, which have, it normally has a strategy somewhat like this, plus some yield farming where you're earning a token and then it's selling it for profit. So that is a different risk profile that we're not going to talk about today, but just kind of differentiating between the two of them. Lending, again, I think is the simplest versus if you are, let's say, lending and being a liquidity provider and using a Y vault, that adds some risk, but also potentially some reward. Okay, Teddy, anything else that you think we should cover in terms of DeFi lending, or anything else that you wanted to share about Notional Finance? Like, wondering, like, how can folks get started? Where should they get in touch with you as a team?
Yeah, so, you can try the product out on the website, or you can follow us on Twitter at Notional Finance. And, probably the best thing to do, in my opinion, is jump in the Discord. So on our Twitter handle, we have a link to our Discord. And I think that's probably the best place for anybody to get started.
Yep. Yeah, and if you go, reminder, what we were showing earlier was at notional.finance. So if you go there, they've got a link handy at the at the very top of the screen there. So you can hop into their Discord. Teddy, any product releases that we should keep our eyes out for in the next month or so, or I guess anything else that's new that's coming?
Well, so we just launched fully last week. So for the time being, really kind of our main focus right now is building awareness, letting people know we're here, and kind of driving the usage of the initial product. Now we're very hard at work on V2, and V2 is going to have some super exciting stuff that I will be very happy to share with you once we've sort of finished it. But for now, I'm going to keep that one close to the vest.
Yeah. No, that sounds great. I think a lot of people like myself, just a few weeks ago, you guys had gotten in touch, and I was like, I didn't know that this exists. So this is cool. And I think this will be a money Lego we can all look forward to. There's a lot of functionality here and other exciting functionality that I would anticipate you guys are going to be building. So, well, I think that's everything we're going to cover for today. Thanks so much for your time. This was great to be able to have you on as a guest and talk through this, because you would know better than I. Curious, as a final question, any books you'd recommend reading that would help folks to understand everything that's going on in DeFi, or maybe to learn from history about all of the explosion of innovation that's happening in DeFi right now?
Oh man, that is a very good question. To be honest with you, I haven't really read any books on crypto. Most of the time, I've just been, I guess blog posts. Because I'm just trying to think about how I kind of figured it all out to the extent that I have. I guess, yeah. It's mainly just endless hours just scrolling the internet, I guess, to be honest with you. Yeah, I don't know if anybody's really written a book on DeFi yet. So it's a little early.
Yeah. I'll tell you what, I recently started reading, so this isn't about DeFi, but I really am interested in just the history of the stock market, the history of finance. And I was reading this book, or I'm listening to it. I can never remember the title of it. It's Devil Take the Hindmost. It's like a history of speculation, and it paints a picture of why speculation can be really powerful in terms of moving society forward, moving tech forward. But it also talks about really the cycles of human behavior. So I tend to focus mostly obviously on the utility of DeFi, but it's been interesting to read this, because I definitely am seeing some of the cyclical behavior of the past.
All right, I actually do have a book in that vein. It's a history. It's written by this guy who I believe won the Pulitzer Prize, not for this book, but maybe one of his previous books. But it's called American Colossus, and it's the history of American capitalism in the pre-World War I period. So it's I think so the period is after the Civil War and before World War I. And sort of what it goes over is how essentially the railroads got built, right? And the West sort of got settled, right? And built up. And it's a really interesting look at essentially financial incentives and the way people behave. And it's not always pretty, but to some extent it gets the job done. But it's an interesting thing of you achieved it helped the railroads get built at just enormous. Well, there's just a lot of stuff happening, and a lot of it was totally wasted energy. But in the end, they got built. don't know. It's an interesting look at history, and you can definitely see some parallels in DeFi today.
Yeah, absolutely. Like I think what I've been picking up on is just the parallels to all of crypto. I mean, it's really interesting to like learn about the Amsterdam Stock Exchange, and like it goes beyond like the stories of tulips, which I think any of us in crypto, if you're here long enough, like you've heard a comparison from those normally on the outside who have little to no experience. They're peering in saying, "Oh, it's a tulip mania," and yeah. Anyways, the book's fantastic. It really like it talks about. It is very objective and doesn't try to like bias you towards whether it was good or bad. But I gotta say, I've been I've just been more fascinated by like all of the behavior. All you have to do is just remove some words and paint it in today's terms, and you're like, oh, like that shit's happening again.
Yeah.
And again, I mean that in a good and a bad way. Like you see it. Yep. Like they talk about the onset of like options and derivatives, and like it's pretty incredible how sophisticated the stock market was 300 years ago. Yeah, back in the 1600s, 1700s. So
what's the term, Travis?
Oh, it's called Devil Take the Hindmost. It was recommended to me on Audible. Audible, yeah, Audible's got me addicted. It's fun to listen to books. I find it harder to like sit down and read because I'm always like
wired.
Well, I want to remind everyone, make sure follow at Notional Finance on Twitter. You can follow all of the updates from Notional Finance. More importantly, check out Notional at notional.finance. You can hop in their Discord if you have any questions. And reminder that this Wednesday we'll have an interview with Austin Griffith. He's like a well-known but like beloved, Ethereum hacker. Everybody loves Austin. He does this Bowtie Fridays. So if you don't know who Austin is, you would absolutely love learning from this guy. Like I feel like DeFi Dad at times is just like it's like a derivative of Austin that's not a developer. So I've always been really inspired by his enthusiasm and all that he's done to help the Ethereum and now DeFi community. Before that, though, too, we'll also have on the founder of ethblock.art. So we're going to talk about this really interesting trend that has been going on for some time where you can generate art from the blockchain based on blocks using different templates. And in this case, you can actually tweak the templates with colors and all the different like positions of the piece. So I was playing around with it the other day, and I think people find it really interesting. Other than that, Teddy, thanks again. If you hang out a minute, I'm just going to close this out and would love to see if you have any other questions offline.
Absolutely. Thanks a lot for having me.
Oh, shoot. By the way, one person just asked, where can you find DeFi class recordings? For that, you want to go to tv.zapper.fi. So they're all there. And there was the name of the book, again, was Devil Take the Hindmost, HINDMOST, Devil Take the Hindmost. And then this is a tough one. We missed this earlier. Do you have any thoughts on this, Teddy? Like, do you think yeah. Do you any thoughts on like just like where we've gotten to? Like, we're not saying that a big drop can't happen again, but I think like I would simply put it as this: we didn't have 25 billion in total value locked. We didn't have, let's say conservatively 50 plus apps that have major traction in DeFi, which is probably closer to about 100 different money Legos. We didn't have 1 million wallets registered using DeFi applications. We didn't have over 5 billion in Bitcoin tokenized on Ethereum. That wasn't 140x growth. Like we've had 140x growth in that just over the last year. None of that existed then. We didn't have the Ren bridge working. Like we didn't have Curve. There's just so much excitement now, and there's so much utility. So I am not saying the drop can't happen in the future, like a big drop, like a 70, 80% drop, 90% drop. But yeah, I think that crypto tends to be very reflexive on the way up and the way down. And over time, though, with everything that's happening, the liquidity, the traction of users, it's kind of like, it's like volatility that's getting narrower and narrower and narrower. And anyways.
Yeah, I think that's fair. I mean, you can definitely see we're on the way up, right? Like now there's going to be some kind of like stuff like this around the trend line, but we're going the right place. And I think more important than the price, as you were saying, was really the fact that people are actually using this now, and like people are actually doing things. Like,
it's a wonderful thing.
It's amazing. Yeah,
it's a wonderful thing. I never dreamed 3 years ago that we'd have all this utility. It's like the amount of utility is actually more than what I would argue most people expect out of it, both crypto natives and those outside the space. So it is a much better feeling to have meetings with people who are like, wow, like I didn't realize all you can do, versus I would say 2 to 3 years ago, they're like, so what can you do? And you're like, well, it's a store value and a transfer value. It's global and it's central.
Yeah.
But you need an internet signal, so that eliminates a lot of people. And like it was a much more ivory tower conversation. Now it's like, yo, like these are bankless money apps that work better than, I would argue, a lot of different banking applications. So anyways, Teddy, thanks so much for your time. Thanks everyone for tuning in. All right, we will see you on Wednesday at 11:30 a.m. Eastern with the founder of ethblock.art, and then Austin Griffith right after, including we'll have Suhail, who is one of the co-founders of Zapper, who's going to help us to chat more with Austin about all the cool stuff he's working on. So anyways, thanks so much, everyone, and have a great day. Thanks, Teddy. I'll catch you in just a minute.
Thanks.